Welcome to the Startup Evangelist Ideas for Africa. In this course, we will learn all about equity fundraising from venture capital or VC. VC fundraising is one of the ways to finance your business. It is a unique type of fundraising, different from other types such as debt raising, grants, or other forms of financing. Module 1. The planning phase. In this module, we will be learning about the key players, the prerequisites, the art of raising money, different financing stages or phases, as well as the nice-to-haves whenever you are fundraising. Unit 1. The players. The first key player is the entrepreneur. This is typically the founder or team of founders of the company in question. The second player is the venture capitalist or the VC. VCs do come in various shapes and sizes. The most important factor to consider is to find an entrepreneur-friendly investor. You can do this by referrals and active due diligence and in knowing which type of VC you are dealing with. In terms of structure, the most senior person in a VC firm is called a managing director, MD, or a general partner, GP. Next in line are principals or directors. They usually have some deal responsibilities but may not make the ultimate final decision, especially if such deals have a formal investment committee where they are presented. Next in line are the associates, and lastly, the deal analysts. Usually they are involved in the active relationship management and analysis of the transaction. The next player is an entrepreneur in residence. These are often part-time members of a VC firm. They may be experienced entrepreneurs who work at the VC firm up to a limited period, in most cases a year or less. While they are working, in most cases they will be working while figuring out their next company. Some VCs usually pay the entrepreneurs in residence, while others simply give them free office space with an agreement to invest or finance their next company once it's formed. Angel investors. These are the other stakeholders. In most cases, these are individual funders who support your business or enterprise prior to the VC institutional capital. They are commonly known as angels, and they usually include career professionals, successful entrepreneurs, friends, or family members. The other stakeholder is the accountant, who helps you in bookkeeping and tax filing during the fundraising process. Last but not least, you have the investment banker or transaction advisor. They usually help you in the fundraising round. For instance, they may help in sourcing investors, due diligence, and preparation of the fundraising materials such as the financial model. Usually, the smaller the ticket or the earlier the stage of financing, the less likely an investment banker is involved. Unit 2. The prerequisites. An important prerequisite for an entrepreneur is to due diligence the investor as much as the investor due diligences you. One way to do this is critically analyzing the information presented in their website, knowing which types of stage of businesses they finance, the types of sectors or technologies or asset classes, and making sure your business aligns with their mission. Another way to DD is talking to other entrepreneurs who have worked or who have engaged previously with this investor. Another prerequisite is choosing a good lawyer who will help you in the negotiation process. Another prerequisite I would recommend is be proactive rather than reactive. For instance, prior to your fundraising tour, you need to have a data room ready. This could be in the form of a Google Drive, Dropbox, Box, or Kata, or similar type of virtual filing system. The data room should have key information that an investor would usually ask for or request during the due diligence process. Unit 3. The art of raising money. When raising money, it is important first to determine how much you're raising. Avoid giving ranges. For instance, avoid saying, "I'm raising $1 to $2 million." Be specific in your ask, and also have a clear understanding of the use of funds. For instance, how much of the $1 million you're raising would go to marketing, team development, or other types of cost centers in your business. This shows the investor that you clearly understand the use and the proper allocation of resources once they have invested in you. The other critical aspect, as mentioned previously, is to have your fundraising materials in place. For instance, a short business description that you can use on email solicitation, a slide deck presentation, a business plan, or similar documentation. Another aspect is a financial model that clearly captures or highlights your growth projections from a revenue and cost perspective. It can include a detailed balance sheet, income statement, or cash flow statement, as well as your own perspective on valuation. In some transactions, you may require to have a private placement memorandum or a PPM. This is another typical business plan, but with additional legal disclaimers. In most cases, it's used when investment bankers are involved. Another aspect to have is a product demo. This might work well, especially if you have a tech product that you might want to showcase either in video form or other forms of visualization for an investor to appreciate what type of product you're building. When talking to multiple VCs, it's also important to identify and find a lead VC. This is important because it will help streamline the negotiation process, as you will be negotiating with one lead VC that in turn would coordinate the inputs from the other VCs that are involved in the same fundraising round. Unit 4, different financing stages or phases. The earliest financing stage is the seed or the pre-seed round. Typically, these are investment rounds where the business is pre-revenue or is yet to make any revenue. In this stage, this is the least contentious stage of negotiation. However, it has the probability of generating a lot of mistakes for future financing rounds. For instance, if you get on a deal with great terms but you are unable to back them up with your performance later on, when you raise your next round, you may find yourself at loggerheads with your previous investor, who at this point may actually be seeking an exit. For instance, in the next round, if your valuation is not higher or at a higher threshold than the previous round, you will be diluting your original investors. So in this case, you may either have to make concessions and make them whole, or in the worst case, they may block the new fundraise. The second stage is early stage. These typically are post-revenue transactions where traction may be considered as a factor for investing. It may be important to pay attention to the protective terms or provisions in the deal at this stage. You typically do not want to have different protective provisions to different preferred shareholders. So you might want to bring them together so that they have one voting block. This dynamic is also influenced significantly by the number of different rounds you expect to raise. The more you expect to raise in future, you may want to have a clear understanding of the protective provisions. Mid and late stage. These are later stages where a company has scaled and has grown and is in most cases near profitability or is even profitable. In later stages, board composition and voting control starts to have a bigger weight in your negotiation process. In these rounds, revenue growth traction is a critical factor for consideration, as well as aspects of profitability. So in this case, profitability metrics such as EBITDA may be considered as a multiple for valuation. Unit 5, nice to haves. It is important to have a complementary co-founder. Avoid having a situation where you are a solo founder, as investors perceive solo founders at a higher risk. A complementary founder may be a founder or a co-founder who has a different skill sets that complement yours. For instance, if you are a techie, you might want to have a business or a commercial co-founder or someone with a similar background. If you are starting a business, say in Africa, and you do not have a background or context working in Africa, you might want to consider a co-founder from Africa. In some cases, investors might insist that at least one founder is full-time. I know this might be challenging, especially when you're bootstrapping, but it is a useful discussion or consideration to have before you fundraise. The second nice to have is to have a decent runway to accommodate potential funding delays. For instance, if you anticipate to take 6 months to fundraise, you need to have at least 9 months of capital to bootstrap your business. Another nice to have is to have a minimum viable product or prototype, or commonly known as MVP. This especially is critical when you're fundraising for investors who typically might want to see a product in action before they invest. Idea stage founders or funders outside angel investors might be difficult to come by, especially in the current environment. End of Module 1.